In only 5 months, Nvidia has gone from 480 to 1140. That's an eye-popping 136% return. Nvidia recently announced a 10-for-1 stock split. So what is a stock split? Does it matter? And what should you do? Let's dive right in. So before we can understand a split, we have to understand what is being split, namely the stock. So stock is synonymous with equity ownership in a company. Equity owners purchase the stock, which gives them ownership interest in the company. This ownership interest allows them to vote for the board of directors, which are the advocates for the shareholders. It provides income via dividends, and most importantly, price appreciation when the shares increase in value over time. Now, before we can discuss a stock split, we need to understand the concept of shares. So back in the day, you would actually receive a physical stock certificate, which would outline the number of shares that you owned in the company. Now that everything's electronic, there's no more stock certificates. But if you were to stumble across some old stock certificates like Brendan Fraser in the movie Blast from the Past, you could be in for a pleasant surprise.
These are stock certificates. Your mom and I bought them for you. Of course, they're worthless now, but at one time they were quite valuable.
10,000 shares of each. They'd be worth millions.
The shares that get split are the outstanding shares. So what are outstanding shares? First, there are authorized shares. This is the total number of shares the company can issue over its existence. Then there are issued shares. This is the total number of shares that have actually been sold by the company over its lifetime. Treasury stock, these are any shares the company has repurchased and currently holds. So many household names that we all know have large share repurchase programs. Think of McDonald's, Apple, Alphabet, and Nvidia as well. Now, outstanding shares. This is the issued shares, less any shares in treasury that the company has repurchased. These are the shares that will be split. If you're finding this helpful, please smash that like button. So what is a split and why do companies do it? There are two types of splits. There's a standard split, which is increasing the number of shares to reduce the price. And there's a reverse split, which decreases the number of shares to increase the price. So I'm going to start with reverse first. If a stock goes below $1 per share for 30 days on the New York Stock Exchange, it gets delisted. So a 1-for-10 reverse split can be done. For example, if you have 100 shares at $1, you're given 1 share for every 10 that you currently own, which will give you 10 shares at $10. So it's 100 in either case. You're basically indifferent. Now, why would companies do that in the first place? Well, if a company gets delisted, it's going to be much more difficult to try to raise capital in the future. It's also a massive negative on the company and the stock as well. Now, a standard stock split, this is why Nvidia is doing a 10-for-1 stock split. In the company's own words, quote, to make stock ownership more accessible to employees and investors, end quote. That's why we're doing the split. Now, research conducted by NASDAQ looked at the optimal stock price for minimum bid-ask spread and maximum liquidity and concluded that $100 per share is the optimal stock price. Very interesting. Now, you're probably asking yourself the question, okay, does it actually matter? Now, here's the tricky part. It should not matter at all whatsoever. If you and I have a pizza and I get half and you get half, we each have half. Now, if you said, Ken, I'm unhappy, it's too big, I would get that. I could slice it into 4, 8, 10, or 12 slices, but the fact of the matter is it doesn't change the size of the pie. Now, psychologically, you may feel that you're getting more if I cut it into many slices, but you're not actually getting more. The same is true for Nvidia. If you own 1 share at $1,000 or 10 shares at $100, the total value of your stake is still $1,000. Now, what actually happens after a split? So we have a few recent examples that we can dive into here. Walmart actually split 3-for-1 on February 26th of this year, and the stock is up over 9%. Now, Chipotle merely announced a stock split, 50-for-1. They still haven't split yet. They announced it on March 19th. The stock is up almost 13% since. And obviously, the subject company, Nvidia, they announced a 10-for-1 stock split last week, and the stock is up 20% in 1 week. Bonkers. Now, data from Bank of America, which was revealed after Walmart's split announcement, showed the average 12-month return after a stock split is 25.4%. Considering the S&P 500 total return over the last 100 years is 10.1%, that's quite impressive. So how does this make any sense at all whatsoever? The reason for a split is a high price that's typically increasing. Now, how and when does that happen? It's because a company is having positive operating results and positive operating momentum. So the likelihood is, split or no split, the stock price is going to continue to go up and to the right. Now, what should you do? I'm not a financial advisor. I don't know you nor your situation, and this is only for education purposes. But personally, I would never buy a company solely because of a stock split. The reason to buy a stock is because it's trading at a discount. It's below its intrinsic value. We always want to buy a dollar for 50 cents. That's the value investing way. Now, full disclosure, I do own shares of Nvidia and I am positive on the company, but I do feel like it's gotten a little bit ahead of itself. I'm more interested below $1,000 pre split or below $100 post split. Now, if you want a deep dive analysis on Nvidia, check out my full 3-statement financial model right here. Please share this with someone who you think will find this helpful. And as always, be relentless.